Welcome to the September 2023 live stream. So I am very excited about tonight because we get to talk about my expertise, what I really love, why I got into this business, and that is retirement planning case studies. But before we get into that, we felt that a stock market update from Chris and Charles from the investment team here would be appropriate because I know there's a lot of questions out there since we did the last live stream where the title wasn't exactly stocks are stalling, bonds are falling. It was the July. We did it in July, I believe,
Right.
possibly in early August, maybe mid-August. But we talked about how we expected the stock market to most likely continue to stall through the end of the summer. And we talked about some of those reasons, what was going on, what possibly could happen. And we have a very, very interesting dynamic right now because rates are at levels that we haven't seen in a very long time. And as rates go up, bond prices go down. So when you have stocks going down and you have bond prices struggling as well, the investor is left in a unique circumstance, one that we don't see too often in this country. And as a matter of fact, last year in 2022, I believe was only the third time in history that both stocks and bonds were down in the same year. A lot of times they will be positively correlated, meaning they move in the same direction, but usually that's either they both go up or they could possibly both go down. So really a unique situation coming off what we saw in 2022. And here we are, 3/4 of the way basically through 2023. And we had an amazing rally, mostly tech stocks in the beginning of the year. Dividend stocks, a lot of value stocks have really struggled by any metric to keep up with those kind of high-flying growth in tech names. So, but here we are, end of September, third quarter's coming to a close. The market really hasn't gone anywhere since we did at the Westin, we did our second half outlook and our first half review where we talked about, again, we don't expect much growth in the market over the next 3 to 4 months. So Chris, where are we now? What really has transpired over the past, let's call it 30 to 60 days since we've last communicated with the audience here? And I'm going to throw it to Charles a little bit and let's talk about what we expect possibly for the next 3 months.
Thanks, Troy. We are exiting summer, which is a good thing in the stock markets. At the same time, it's still a little early to get really positive on the fourth quarter. As Troy was saying, we put out a couple podcasts and YouTube videos late June through mid-July talking about the summer stall was coming and upon us, how a lot of the sentiment numbers had gotten very upbeat, a lot of the investor enthusiasm for the markets and AI stocks and tech stocks had gotten kind of overheated, and did a couple podcasts and was like, if you are running a hedge fund or kind of market timing trading, it's a great time to just take 3 months off and come back later in the summer. And sure enough, that's pretty much what's happened. The market is the same level it was in mid-June. It's the same level it was last year, and I think it's the same level it was 2 years ago. So we have been treading water for quite some time now, largely because interest rates have been going up. The Federal Reserve is trying to slow the economy and slowing inflation, and they're succeeding on inflation, but they're looking at some metrics that lag the economy, and they're still talking about raising rates maybe later in the year one more time.
So you never know kind of what it is that might get you to a point like this, but what we do see and what we tried to highlight is that there was a risk that things could stall out, and as it turns out, a confluence of factors that come together to create a situation where there's a lot of uncertainty, right? Whether it's upcoming earnings, what are the next actions of the Fed going to be? Rising oil prices, repayment of student loans. Now, headline risk may be, government shutdown, which has very little economic impact, on a short-term basis, but it's headline grabbing, and it captivates people's attention, and it drives the investor sentiment, and that's exactly what's happened, and things have transpired. To Chris said earlier, right? One of our earlier, notes was we're returning to the old normal, right? Economic cycles, presidential cycles, these things all tend to line up and trade in a fairly similar fashion, and that's exactly what we're seeing today.
So as we go through tonight's live stream, we're going to talk a little bit more about the stock market, where we are now, some of the possible outcomes over the next 3 months of which direction the stock market could go, the bond market, interest rates, and how this all impacts you and your retirement portfolio. we're going to do a raffle about halfway through tonight's live stream. And in order to win the raffle, you have to attend. You have to be here on the live stream. But it's going to be a $100 gift certificate to your favorite restaurant. We're going to reach out to you, the marketing department will, and set that all up. Then we're going to transition from the investment discussion to the financial planning and retirement planning discussion, where we're going to talk about the things that we do every single day here at Oak Harvest Financial Group. The stock market, the stock market's more sexy than the bond market. But this is the conversation that people like to hear because it directly impacts you. Many people who watch these are not clients of Oak Harvest Financial Group. We do these for our clients, but we also want to help you understand what's going on with the economy, how that impacts the stock market, how that impacts your retirement, because many of you will never sit down and talk with, but we still want to make sure that you are able to sift through all of the noise that's out there and can really bring it home to how it impacts you and your family. When we get to the financial planning part, what we do here at Oak Harvest is answer a few basic questions for our clients. Do you have enough? How long will your money last? How do you pay less tax? And if something happens to you, will your family be okay? So in the second half of tonight's live stream, we're going to go through case studies where we answer those questions and we actually talk about steps that we've taken, our advisors have taken here. We're going to bring up Ed Rossi and also Dustin, who many of you have not met Dustin yet. It'll be his first time on the Oak Harvest live stream, so we're really excited about that. And we're going to go through the financial planning case studies. So that's what you can expect tonight. And continuing this conversation, we feel that the market really, I guess it happens every summer. There's a lot of different things that could pop up. Charles, you alluded to it. If I think back over the past just 3, 4, 5 years, you know, under the Trump years, it was China. It was a tweet maybe that Trump would put out on a Friday, and I'd look over at Chris. The market would be up, and he'd say, gosh darn it, Trump just tweeted something, and the market dove 200 points. Yeah. And then, you know, it was interest rates over the past year, the soft landing, the government shutdown, all these different things that possibly or that pop up. We don't necessarily know what they're going to be, but you guys have been doing this for a very long time. We talked about it earlier, combined more than 50 years. And you guys have alluded to this for many years, that we don't know exactly what's going to pop up, but we do know something's going to pop up. So how are we navigating that? And Chris, I guess a two-part question here. Feel free to answer that about what has popped up that Charles alluded to, but what could pop up over the next quarter that could possibly send the stock market in one of two directions?
Okay. Yeah, thanks, Troy. And I'm not sure if that 50 years was a compliment for us or not,
I'm
or
going
kind
as
of
a
backhand.
compliment.
We're all friends here, so I just wanted to reach out and tell everyone.
You have so much wisdom and experience.
Yeah, I want to reach out and tell everyone Troy's birthday was yesterday, so give like us, call us, say happy birthday to Troy when you get a chance. So, some of the things that have transpired over the summer, as Charles mentioned, oil's up a lot. You know, there's higher demand than people expected. There's lower supplies because of what's going on with the Strategic Petroleum Reserve and what the administration has done over the last 18 months to combat pricing with Russia. There are all sorts of events out there. Something you mentioned actually in your prelude to this question was, what do you feel, right? And what I try to do more than anything else as a portfolio manager is not feel, right? Feel is a 4-letter word. And in the stock market, one of the best things to do is try to not feel. You're supposed to look at data. You're supposed to be objective about things and not overlay my feelings. Because listen, I get as scared and apprehensive and anxious as anyone, right? I mean, whether it's the COVID crash or, into Christmas of 2018. What Charles and I and the rest of the team try to do is try to look at things in advance and say, hey, what are the odds of something bad happening or something good happening? And, kind of weigh those odds and tilt the portfolios to get a little more aggressive or a little less aggressive during certain times. And things just repeat themselves over and over again because the financial markets are made up of millions of people, millions of humans, and we are consistent in our behaviors in large groups, right? We make the same mistakes, we make the same decisions time and time again as a collective group. So As an investor, if you can look at that data, a lot of times you can kind of get an edge because you're like, hey, seen this before, it's happened before. When this happens, 60% of the time, 75% of the time, the next 6 months, this is what happens, good or bad, and that's what we try to do.
So yeah, I just to follow up on that, what we try and do and what we're bringing to bear at Oak Harvest, which I think is very different from a lot of other RIAs, is this institutional mindset where for Chris and I, right, we have relied upon, we're very unemotional. You can tell from what Chris said, we're probabilistic in nature and how we behave, right? So for us, we put in place a thoughtful, disciplined process in place that creates a roadmap that allows us to follow it in a very consistent manner over time, over market cycle. And we've done it over numerous market cycles, economic cycles. The
50
internet
years.
bubble, the internet bust, yeah, a long time. Thanks, Troy. So what it does for us, though, is it is what we can attach our thought process to that creates a platform that at least gives us the opportunity to generate consistent returns over time. Take the emotional aspect out of it. So I think that can't be underemphasized. Take a step back. Here's sort of a little known fact because we've been doing this for a long time, right? Well, if you think back years ago, Chris and I were the masters of our domain in that we ran these actively managed mutual funds, and they were very large funds. And we talk about how then seasonality enters into the equation and how like September and October tended to be volatile months. Some of the biggest downdrafts occurred during those months. Little known fact here, folks, the fiscal year end and Chris and my incentive compensation based upon the performance of the fund, that calendar date was at the end of October. Let me tell you, if you've had a pretty good year and you see something bad about to happen, you hit the sell button, pal, right? And that was just us and that was everybody else. So fund managers were incented to hit the sell button as soon as anything bad rose its head, and it would typically happen in the latter parts of the summer. Yep. And it was just sort of a calendar effect too that has added to that.
And we actually discussed this in one of our videos 3 months ago about that was one of the summer, risks or whatever to a down September, early October timeframe is that, with all these tech stocks up, whether it's NVIDIA or Apple or whatever, institutional portfolio managers whose tax years end at the end of September and the end of October look at their portfolios and say, I own XYZ, it's up 200%, and I own another name and it's down 30%. I don't want to show everyone in the world that I own this dog that's down 30%. And I probably own too much of the one that's up 200%. I'm selling some of both, or all of the loser and some of the winner. And it just creates supply into the market when most investors are on holiday. They're getting ready for the school season coming up and back to school. If you're a 401k investor and you're a higher wage earner, you've already maxed out maybe your 401k contributions. The good thing is we're getting through that. Historically, mid-September around option expiration, which is around the third week in October, is historically near the low point of the market. And investors on the institutional side, they look at the third quarter earnings reports, which have usually been worse than expected because it's summer. And people have cut their estimates and hey, I can look out to 2024. And in general, we're an optimistic society. So they look at 2024 or the next year out earnings estimates and say, hey, the market's going to grow 10, 15, 20% earnings. I'm going to buy these stocks. And that's why you tend to get these rallies into Thanksgiving, into the end of the year, because earnings estimates and growth factors start to look out to the next year. They reset.
And for us, and with our process, right, we hold ourselves out as active managers. So we actually, we build our portfolios one stock at a time, but we do take this top-down view and assess these factors and make adjustments accordingly. And so we can actually position ourselves as best we can with our structure to take advantage of that. Whereas if you're own an index fund or a passive investor, it doesn't matter, right? Prices does no object, right? Your every dollar that you invest in that fund is allocated based upon a mathematical formula, regardless of the investment merit of the individual position.
So, I mean, whenever we do these, not just these live streams, but when we have our investment committee meetings, when we have our advisor meetings on Monday mornings, and when I get to spend personal time with you guys, I always feel like I learned something. I always feel like really just proud that you guys are responsible for the investment department here at Oak Harvest Financial Group.
That's because we're old. 50 years and counting between us.
Besides the experience, I would like to take a moment before we acknowledge some people on here and we ask you for your questions, and then we're going to segue into what they think could possibly happen over the next 3 months, because we haven't got to that part yet.
Sure.
But so far, really, really good conversation. But Chris, you've managed the #1 ranked fund by Lipper, the #2 ranked fund over both 3 and 5 year periods. You know, some college up in the Northeast there will go unlettered, unnamed with the crimson colors. Your MBA from Harvard. Charles, 3 5-star funds from Morningstar. I believe also the #1 ranked fund by Lipper in your career, not to mention a host of other accomplishments. And if you go to our website under the investment team, you can pull up both of their bios and see exactly what I'm referring to there. But you guys have accomplished a lot in your careers. And one of the things that separates Oak Harvest from many of the other RIAs that you had alluded to, Charles, where we bring an institutional mindset, maybe I shouldn't say most, but maybe most of the RIAs that I know, okay, and it's probably most of the RIAs out there, but I can't be certain about that. So a lot of our RIAs, and for those who don't understand it, RIA stands for a Registered Investment Advisor. So that's what Oak Harvest Investment Services is. So we're a Registered Investment Advisor firm. Most RIAs outsource the investment management to third parties who, what that does is that creates a layered fee structure. So you pay your advisor, let's say 1%. They outsource it typically to what we call a third-party money manager, where he or she is charging a fee, and then typically they go into mutual funds, possibly ETFs, but you have another layer of fees there. So what I decided to do here at Oak Harvest Financial Group is say, you know what, I don't feel comfortable with that layered fee structure. I'm going to go and find the best institutional investment analysts and fund managers that we can find and bring that to bear for our clients here at Oak Harvest Financial Group. So just a kind of little food for thought there, I guess, or a little maybe behind the curtain, behind the scenes of really what makes Oak Harvest Financial Group different.
It makes us very different. And just, I know Charles and I have been out here on the podcasts and YouTube videos for the last couple months. I just want to say there's more behind the investment team than Charles and I. There's Dwayne and Chris and James also on the investment team. So, you know, we have someone who's dedicated towards trading and operations. We have analysts. We have a quant. So it's just bigger than what you see on YouTube and the faces here.
Sure, that's a very good point. Yeah, we just like our firm does from a financial planning standpoint, from that side of the business, you know, people are specialized in what they do. That allows everyone to do their job very well, as opposed to the person who tries to do absolutely everything and only does it in a, you know, mediocre. It's just the way it works. So, but I was going to come back to something else that Troy said. So as an independent RIA, we're able to do a lot of things, and people say, well, maybe, you know, what about like Morgan Stanley or UBS? And then at sort of the other end of the spectrum, maybe there's some prestige associated with that. However, when it gets down to where the rubber meets the road in the investment program and philosophy, it's devised and dictated from somewhere way up on high that is done in a manner that can serve, you know, 100 different types of clients. Here at our firm, right, I have to walk by, whether I want to or not, Ed 10 times a day, and he can grab me and say, "Hey, what are you thinking?" It's the same thing with Dustin.
Why did you buy this dog, Charles?
Yeah, right. And so we have to answer to those folks, because they're going to have to answer to our clients.
They're the ones that are going to hold your feet to the fire, because they're the ones that are sitting there talking to the clients.
That's right.
You know, 8, 9, 10 hours a day.
Exactly. And so what we try and do is you know, always be available to them, explain clearly what we're trying to do, and make sure that we do a good job of saying what we do, but then doing what we say. Yeah. And that creates just a tremendous amount of value, I think, for our advisors and for our clients.
Okay, we have the raffle coming up in about 10 to 12 minutes here, just kind of depending how long the conversation goes. We're going to jump into expectations for the market into the end of the year. And if Chris is feeling a little bit froggy, we may jump into the first quarter of next year.
I'll do it. I'll do it.
But before we do that, I want to say
feeling cocky tonight.
want to say hello to a few people here. So Bonnie in Modesto, how you doing, Bonnie? Fast Eddie from the DFW, thank you very much for joining us. We are opening an office in Dallas, actually in Addison. It looks like over the next possibly 30 days. So Fast Eddie will be in your area. I'm not going to try to pronounce this, but someone from LA, Larry from Kansas City. Larry, I was just in KC, obviously had some good barbecue. I'm a Lions fan. Sorry my Lions beat up on your Chiefs. Heck of a game, though. Really, really had a good time. And, you know, Kansas City probably needs to do something about that one-way in and out to Arrowhead there. But really, really thank you for joining the live stream tonight. Go Lions. Omega Man from Sugarland. Dave Blumentritt, welcome. Have one of your questions, Dave. I'm going to try to get to it at the end of tonight. John, how you doing? And a few other people here. Crazed Cat says, happy birthday to me. Thank you very much, Cat. I do appreciate it. I've been telling everyone around here how much wiser and more experienced I feel since my birthday yesterday. So thank you very, very, very much. Okay, guys, kind of time for the rubber to hit the road here. Obviously, you don't have a crystal ball. You can't say exactly what's going to happen, but probability-wise, potential direction, where's the market possibly going and why from here? We'll go to you first, Chris, and then Charles, we'll let you play cleanup here.
Okay. First, everyone says you don't have a crystal ball and they ask you for opinion. So you do have a crystal ball, right? It may not be clear. It's usually cloudy. You know, the question is it 100% cloudy or 50% cloudy? But you have a crystal ball, right? Because we all have experience. We've been told we have 50 years experience. So the crystal ball, you know, we started the year and the title of this year, 2023, was The Old Normal, right? Mohammed Al-Arian at Allianz and PIMCO, you know, termed the new normal. Well, last December, we're returning to the old normal. And the old normal is there are business cycles, right? The Fed is not going to come to the rescue of the markets all the time and come to the rescue of the economy. And with that, you know, we had certain kind of anticipations of what the first half would look like. Is that because we're like omniscient? No, right? We all make mistakes in this business. It's the most humbling business in the world. I have no hair because I'm in this business, and I take it, our clients' money, very seriously. So knowing that year to date, it's been a very normal year, I'm going to stick with its normal. And with its normal would mean we're going to have some volatility for the next 2 to 3 weeks. You know, most people don't like volatility. When volatility spikes, usually that is the time to invest your money, not when volatility is very low. Your highest returns will come when volatility is the highest, if you have a longer term time horizon, because over time, volatility will calm down, your returns compound. So normal would be, you know, we're in this sloppy, choppy mess for another 3 weeks, up until mid-October. We have a pretty good rally into Thanksgiving, which actually might get us right back to 4,600.
On the S&P 500.
On the S&P 500. You'd have probably a little sell-off or to a stall again into Christmas, because that's normally what happens. And then you have institutional managers who want to show that they had a good year, and they tend to mark stuff up. Or, you know, people are done selling, taking tax losses, gains, and stuff like that. And, you know, like happened in 2021, there was a big ramp up right in the end of the year. That is actually normal, right? Followed by a sell-off in January as people say, hey, it's a new year. I'm going to take some tax gains. I don't know what the new year's going to look like. You know, so far it's normal, and normal would be, you know, you kind of go back to 4,600 into Thanksgiving. You might get to close to new all-time highs by the end of the year. That would require lower real interest rates, which we talked about for a couple months. And the real interest rate is that difference between inflation and the nominal rate that you get on your treasury bond. Those have been ticking up since mid-July. If they start coming down, the stock market will, I hate to say rocket, but those are the types of moves that happen when real rates start to fall. People go buy tech, they'll buy energy, they'll buy cyclical stocks, they'll buy the most economy levered things out there because they're like, hey, the economy's still okay. We're not in a recession. It's a soft landing, and I need to be invested. Get me in, buy me semiconductors, buy me software stocks, buy me.
Well, the valuations for those companies become much higher, right? Because
Yes.
once real rates are down, or essentially once rates are lower, whether it's the nominal rate or real rates, tech becomes less expensive when you're buying a stream of future cash flows because you're discounting with a lower interest rate. So that's why I think one of the big things to kind of connect the dots here for the average listener, when you talk about tech possibly increasing and some of those growth stocks, it's because that's a mathematical equation. As interest rates come down, when you discount a stream of future cash flows, it becomes more valuable in the present at lower interest rates.
Yes, yeah, and it's not just the overall interest rate; it's that real component, which is the risk component of the inflation rate. I mean, during the COVID crisis, the Fed took real interest rates. I think it was on 2-year Treasuries, maybe it was 1-year Treasuries, to like -6%. So you are paying our federal government, -6% per year to watch your money. So you were going to lose -6% relative to inflation every year. At the height of inflation in March of 2000, I think it was 21, real interest rates on a 1-year basis got over 6%. Right now they're about 3.25. No, they're 3 3/4. They're starting to come down. If they come down at all in the next 3 to 6 months, and there's a lot of computers that just trade off this information. If that little squiggly line on the chart starts to go down, your stocks are going to go up, particularly on the tech market, and people are going to start making excuses up. It's
The news media will start making excuses.
They will pick
the CNBCs,
anything.
the pundits.
Yes.
Yeah.
So think about the setup then, and I'll add the final equation to it, right? Troy gave a great overview, right? So it's an expected stream of future earnings, and so in this situation where we're set up where we believe real rates and rates potentially are posed to come down a bit, which would benefit valuations, the other component of that is that stream of earnings and cash flow. Well, I think as markets tend to come down, expectations for earnings growth tend to come down as well, and so now expectations have reset lower than they were 3-4 months ago. And so even if you just get decent in-line earnings as we enter the Q3 earnings season, then you have the formula come together on both sides of the equation that could potentially lead
Confluence of events to the upside, as opposed to
upside.
the confluence of events you spoke to earlier that's led to kind of where we are over the past 3 months.
Yeah, one of the notions, or something that's talked about all the time on TV, which to the day I die I'll debate, is that people debate, well, the market's overvalued. It should trade at 19.5 times or 21.5. Valuation is one of the absolute worst timing tools in the market. You will never get in and out of the market based on valuation.
How many strategists have lost their jobs, their high-paying jobs, from trying to forecast and use tools like that?
Because
if you have a 100-year horizon,
yes,
right?
Right.
Yes.
A 50-year horizon, 20-year horizon.
If you have that time horizon, yes, valuations matter, and the time to put all your money into the stock market is when you feel horrible, you probably lost your job, it's a recession, and the economy's on its butt, and the market's down 35%. That will be your highest return ever, compounded. Can people sit around and cash until the next recession and then move all their chips on the table? I don't know anyone who can. Most institutional investors don't have the luxury of doing that. Warren Buffett does. Not many other people do. So, yeah.
And so when you look at some of I know you're a historian when it comes to markets. Charles, I know you are as well, but Chris, you really kind of geek out on a lot of this stuff.
Yeah.
value over long periods of time, value, I'll say that with kind of quotations, has outperformed growth, right? But over the past 15 years, growth has just beat up on value, right? By the pure definition of what's a value stock, what's a growth stock. So just to kind of drive this point home, we have a lot of clients that are followers of Benjamin Graham and Warren Buffett and really talk about value investing, but it's extremely important to understand the life cycle of an investment. And if you do not have 20 years to see that valuation actually come to fruition in the form of a market value, which is very tough to do when you're starting to withdraw money from your portfolio every single year in retirement, that's where, this whole value versus growth argument kind of falls flat in retirement, because I would argue, and let's spend maybe a couple minutes, and I still want to get a very clear, you already told me, Charles, I want to kind of hear what you think about where the market would go. But is not the Fed more important with what they do with interest rates and what happens with real rates over the short term, let's say 1 to 3 years, which is far more important to someone in retirement when they're vulnerable to sequence of returns risk because they're withdrawing money. We're coming off a year where 2020 was extremely volatile. Many people made emotional decisions by going to cash at the wrong time or selling part of the portfolio to preserve. We went through 2022 where stocks and bonds were both down. 2018 was a flat year. 2018, by the way, I don't know if you guys know this. I believe it was 2018. I'm pretty certain on this. Was the only year I wanted to say, and it was either 40 or 50 years, where cash on an inflation-adjusted basis was the best performing asset.
Really?
So when you're in retirement, you just do not have an unlimited time frame to necessarily hold a portfolio of value stocks for 20 years. Now, I'm not going to go down this rabbit hole, but this is one of the reasons why we do have a dividend growth portfolio, because of the increasing income expectation that dividend portfolio can spin off. Because even if the dividend stocks aren't keeping up with your NASDAQ type stocks, they're still good companies that generate consistent cash flow and have a long history of not only paying you that income that they generate, but increasing the amount of dividend that they pay out annually. It's not guaranteed, of course, but they have a long history of doing so. And when the fundamentals of the company, from sales expansion, margin expansion, reinvestment of capital of these management teams, when they've shown over time to be able to be a good steward of the funds that they have and pay that out to shareholders, that is one argument for, we believe, people in retirement to own companies like that maybe aren't going to keep up with NVIDIA and Amazon and Apple, but they're going to keep selling widgets and expanding margins and taking that cash that they generate and saying, here you go, Mr. Retiree, here's 6% more than last year, and here's 8% more than the previous 2 years.
It's 3 yards in a cloud of dust, just like the running game of the Detroit Lions, right? That's what the dividend growth model is. Listen, you can define growth and value in so many different ways that it's been completely blurred. But in my view, the one thing that Benjamin Graham did contribute that we adhere to in our investment program is, what is it that provides you a margin of error? Right. And our view of that is, when we're looking at an investment opportunity, what's your upside opportunity versus the downside risk? Measuring that's your margin, your cushion for error.
You want an asymmetrical risk return profile.
We always incorporate that into everything we do. Everything else that Benjamin Graham wrote as relates to value investing and all, it's great academic work, but it's just been taken in too many different ways. We're growth investors. We know that, for us, we're looking at companies that generate, either consistent or hopefully accelerating streams of cash flows and earnings. And so we take a very disciplined approach to looking at that, and it's looking at what are the primary drivers of corporate profitability: sales, margins, and then that return on invested capital. Those are the attributes. You can go back and back test it, 100 ways to Sunday, and it's all going to lead you to, what made Microsoft, a great company, Home Depot, Procter & Gamble, it's those attributes. And so that's what we focus on. And that's not just in our growth-oriented portfolio, it's also in our dividend growth portfolio because it's important just for the reasons that you highlighted, Troy.
Okay, so before we do the raffle and then bring up Dustin and Ed for the retirement planning case study conversation, one of the things that I love most about the investment team is the open dialogue, the freedom to have a difference of opinion whenever you do have a difference of opinion. So Chris says that over the next, let's call it 3 to 4 weeks, we could possibly experience continued volatility. And then if we get a little bit of clarity with what the Fed is going to do, and correct me if I'm not paraphrasing appropriately here, should see a pretty good rally into the year end, and even possibly we could hit all-time new highs by the end of the year. Any difference of opinion you see there? Any possible outcome that maybe we haven't covered that could transpire?
Yeah, I think to answer your question, no, I'm generally in agreement with that view. I think what's more important is the fact that I'll come about it from a different angle, and what's relevant and what's unique about what we do is that Chris and I will never personally get in an argument with one another. We both respect one another's opinions. We just come at it from different approaches, which is exactly what you want to put in place in an investment team, right? If we're all thinking exactly the same thing all the time, then none of us are really thinking. Right. And so that's why when we build out this team, and
you're not talking about the political parties in America, right?
No, but if we approach the investment challenge from different angles, do we have all of our bases covered? So we look at the world in different ways, and that's then becomes the beauty of how we operate. And happy birthday. Thank you for putting in place an environment that allows that to exist, because it is very unusual for that to happen. So we're very lucky to be able to do that, and we think the opportunity to continue to do it and demonstrate our capabilities going forward are just getting started.
Well, I think I have an idea for next month's live stream. We're going to discuss the way Charles comes at coming to a conclusion versus how Chris comes to a conclusion.
That'll be good.
That's actually a fantastic idea, because
I'm full of them.
We've worked together multiple times, and you're full of something. We've worked together multiple times, and we do have different styles, right? From a stocks picking standpoint, I don't think we really disagree on stuff, but I tend to be a little more top down, macro, looking at, historics and investor behavior and stuff. And Charles has a slightly different style, but we come together and we've worked together now the 3 times, and we've produced some pretty good results over time. Yep. So.
We're going to have to get James on here too, because James is a critical part of the investment team. And Dwayne, if you're watching, we're going to have to try to get you on the live stream one of these months as well. So, gentlemen, really do appreciate it. We are going to do the raffle now. And while we're bringing the raffle out, we're going to trade off Charles and Chris for Ed and Dustin. And if I have any time to fill, I'll go through here and see if we have any questions to answer. But Heather, who do we have as our first raffle winner? Guys, thank you very much.
Lisa Bowen.
Lisa Bowen. Lisa, congratulations for being the winner of a $100 gift certificate to your favorite restaurant. Our marketing team will reach out to you to determine what that restaurant is and also the delivery of that gift certificate. So if you didn't win this one, we will have one more gift certificate at the end of tonight's live stream. We're going to go for probably anywhere from 20 to 30 more minutes here, but I encourage you to hang with us because we have, in my opinion, 2 of the top financial advisors when it comes to dealing with clients and helping to strategize to bring solutions to the table. 2 of the top advisors as far as the passion that they have, the creativity they bring to the table, and the commitment to doing what's in your best interest. So, gentlemen, we have Ed Rossi over here. We have Dustin. Welcome to the table.
Thanks for having us
figured-
again.
Thank you.
Happy belated birthday.
Yes. Yeah.
Okay, guys, let's do this. Ed, I want to start with you.
Okay.
And before I start with you, I want to tell the audience what to expect here. So each of these gentlemen have prepared a case study. So we're leaving out names of clients. We're altering maybe details in a little bit of a fashion in order to just protect the actual real life scenarios. But these are real life case studies. And what we're going to get to the bottom here is how we help to answer the big questions that matter to you in retirement. Do you have enough? Can you retire? How long will your money last? If something happens to you, will your spouse be okay? Will your kids be okay? Will the people that you love and depend on you, will they be okay? And the big one we're going to talk some time on tonight that I run into all the time with the clients I deal with is, how do I pay less tax? You know what? I've saved up all this money in this tax-infested retirement account. And when we go through the analysis with people and they have no idea what a tax nightmare that they actually have on their hands and they see it, well, if you go this way, this is the estimated amount of taxes you'll pay over the course of retirement versus if we actually make some better decisions and go down, you know, this other fork in the road here, potentially 300, 600, 800, sometimes 7 figures of taxes that can be saved in retirement. So that's a big one as well. But those are the questions that people have, and they all revolve around fears that we feel because the difference between the retirement phase and the accumulation phase is you're done working.
Right.
The paychecks are no longer coming in.
Right.
You're not saving and putting into a retirement account. You have to decide, how do I invest this money? How much do I take out? From which account do I take out? How does that impact my taxes? When do I take Social Security? What about health insurance if I retire prior to Medicare? What about long-term care insurance later in life? These are all the dominoes that every single decision that you make tips over another domino, and they all impact your account balances, your levels of income today as potential income in the future, the taxes that you pay, the security of your family. These are huge decisions. So this is why I love what we do here at Oak Harvest Financial Group. Even though Charles and Chris are great, that's what they do is what we call step 1 of the retirement success plan. It's the investment allocation. It's extremely critical, and they play a tremendously important role. But I am of the belief that without a plan of the amount of stocks that you should have in, the amount of fixed income, the amount of more secure assets, where you take your income from, what you're doing with taxes, without having all of that organized and put together in a way that gives you visibility into the future, you simply don't have security in retirement. So now that I've kind of laid the table here, the dinner's been cooked, the utensils are out, the plates are out.
Good night, everybody.
Ed, tell us a little bit about your case study here.
Absolutely. Thanks for having me tonight again. This is always a joy for me. Hello to everybody. Good evening, good afternoon, good morning, wherever you're at. Troy, to put this in context, I started with Oak Harvest in January of 2020. Talk about timing. As a reminder, it was about, less than 2 months after that, we started hearing about this thing called COVID. And things started to shut down. It was kind of a scary time, to say the least. We weren't sure what this COVID thing was. It was a new experience for us all, in a bad way, of course. The other thing that started happening, though, with these shutdowns, and it was later in that year, we're having reviews with clients. And what I started to run into with some reviews was clients essentially being forced into retirement. Their plan turned literally upside down. They planned on retiring maybe 3 years, 4 years, something within that realm. And that was no longer on the table. Their employer said, we've got to keep things afloat, and so we have to let you go. And one of the first reviews I had, and getting used to the retirement success plan and talked about, if you will, trial by fire, was they introduced that we're not going to be able to go back to work. Husband and wife, she was, if memory serves, in her early 60s. He was around his mid 60s. And they were saving very, very aggressively. They planned on retiring in about 4 to 5 years. That, again, all came to a pause. They were now being forced into retirement. And so the concern there was, and to add insult to injury, not to go too far down a rabbit hole, they were the subjects of fraud in 2008.
The victims of fraud
Victims
back
of
in
fraud.
2008.
So bottom line, that's why they were saving so aggressively, and they were already nervous about that, wanting to not go through that again. So anyway, they came into the review with their own calculations of retirement. And based on their calculations, and they were missing a number of variables, thankfully, but by their early 80s, they were going to be living solely on Social Security, which was in no way, shape, or form, and that's not what it's designed for. They were going to be living solely on Social Security, and that was nowhere near what their spending goals were. So whenever something like that happens, I call it a financial planning event. Sometimes the passing of a spouse, in this case, two people losing their jobs at the same time and being forced into retirement. Everything starts over fresh. We start the retirement success plan all over again, looking at their spending, looking at their income, and then also, as you said it, looking at their tax situation. You use the example of domino effect. You've also used the example of a Rubik's Cube, and that is you switch it one way, it has an effect on the other areas. And it turned out in this case, thankfully, that things were not as bleak as they thought. I use the term with them is that your plan is fragile. We want to monitor this, but at the same time, when we started throwing in much more variables than they were overlooking, because they don't do it every day, they're obviously more afraid and taking that, and which is natural, and that is taking it from a perspective of fear and just, okay, I need to be. So it took a little bit of time. It took about a year. We met more often than we normally do to keep them on track. Fast forward, they about 9 months in had, as you describe it, aha moment. And the point of it was because of the plan and not just looking at solely the investment. Should we go all to cash because we need to save what we have? Our paychecks have gone away. Should we go all to stocks to replace what we're losing so the stock market can replace that somehow, which is obviously not wise as well. So looking at it from a more controlled approach. What do you want to spend? What are your sources? How can you pay less in tax? To this day, they're doing just fine.
So just to kind of recap, because you hit on so many key points there. So first you had a client that was a victim of fraud, right, back in 2008. And when we've encountered people that have been victims of Ponzi schemes or straight out theft from either third parties or possibly family members.
Yes.
Some type of catastrophic event that has created a massive loss in trust, in financial security, in belief in the future of their ability to retire, that's an entirely different relationship than someone who hasn't had that experience, right? What many of you don't understand is a lot of times as financial advisors and planners, we spend a lot of our time having therapy sessions. You know, really talking to clients about what they're afraid of, you know, what's important to them. You know, who do they love, and what does this money actually mean to you, and what are we really trying to accomplish here? It's not just about, well, here Bob's your stocks, and here's your bonds, and you made 13% this year, and okay, we'll see you next year. No, they're deep conversations because money is only a tool that allows you to live your best life, to have security for the ones that you love. So if you're not having these deeper conversations about your clients' feelings and who they are and what really matters to them, as far as I'm concerned, you're not equipped to actually make proper investment recommendations, because if you don't have the allocation right based on what a client is afraid of, or maybe what they if they have unreasonable greed, maybe they're trying to accomplish something that's just not Charles talked about it earlier. We want positions that have an asymmetrical, or a portfolio that has an asymmetrical risk to return profile. That's a fancy way for saying mathematically we expect maybe in a down market, in your traditional bear market, this portfolio to lose 15%. Well, if that's the case, we'd like to see 20 to 25% expected turn to the upside. And the greater we can have that spread when we quantify the risk adjusted, or the risk and also the expected returns, then, you know, the higher quality of that investment portfolio that is. But that's just one part. That's step one of the retirement success plan. Then we have how much income should you withdraw? Maybe we're doing a go-go income plan. So with these clients, you know, they were a little bit older. They were working a little bit longer because they had went through some very bad relationships with financial advisors in the past, and they didn't have a 30-year life expectancy, more than likely. But at the same time, the instances or what they went through led them to not have as much money accumulated at that point in life as they otherwise would have. So now it's how much income can we withdraw? Where should we withdraw that income? Should we even worry about taxes at our age? What does that look like? And then, of course, you have, the later in life stuff, one spouse less healthier than the other. What happens if one spouse goes away, you lose a Social Security check. So I'm painting the picture here of the dynamics of what Ed actually went through with this client, because many of you at home, you're a teacher, or you're an engineer, and you're not in the weeds with us every single day, fighting these battles and putting everything that you have and you love and you care about on the line to help people every single day. So context is needed, I think, to apply to the decision-making process when it comes to what are we recommending, why are we recommending it, and how does it actually fit you and who you are as a person. Not just the black and white stocks and bonds investment allocation discussion, that's part of it, but how can we build something that, one, you're going to stay committed to, that, two, gives you a high probability of having the quality of life and the standard of living that you deserve at this point, and three, is optimized with respect to healthcare costs and taxes. And then when you're gone, the people that you leave behind that you want to be taken care of, how do we bring this all together? So I took up a lot of your airtime there, but
no, that's fine.
So talk to me a little bit about how those conversations went and what we actually did. I guess we don't have to get too detailed there, yeah.
First, we had to provide the visibility. I would say a new visibility. We had a new vision for retirement, one that they weren't looking forward to, but one they had to deal with. And so by stepping back, they provided me with their data, because when I first heard that, I said, well, that's interesting, show me what you have. They had very nice spreadsheets drawn out and so on. So then we started to look at that. Then we started to not pick it apart, but started to realize there's where the holes lie. And I started to share it with them right then and there. Well, what about this? Oh, we didn't think about that. Well, what about this? We didn't think about that. And so as we started looking at these things, you could see in their eyes that, hey, okay, there's more to this. And again, there was it took some time again, but there was a small transition to feeling like they were back in control of a situation that felt like it was completely out of control. And so, again, looking at the tax side of it, which is something we definitely don't mind broaching the subject of taxes, that also helped down the road because we had some tax deferred accounts we could take advantage of, but not go too far into different tax brackets, and then go from there into other sources, non-IRAs and such, to where they have their benefits just when it comes to taxation as well. But I would say the biggest thing was, like you said, there was a relationship that I was new to the company. And so that was one of the ways, talk about a way to build a relationship very, very quickly. In my career of doing this for, this will be 31 years, I've said it before, and I said it to you one of the first times I met you, and that was some of my best relationships from my clients came from people that were either afraid or just downright angry, because it's how you react to that, whether it's my fault or not, and how you help to put them back on track or see that they're not maybe as bad as things appear. And then, again, that's one of the things I always say, we require relationships with our clients, not just a minimum as far as an investment amount.
And then one of the most difficult relationships to have with a client is with a client who doesn't share any emotion with you in regards to if they're joyful or upset or whatever that is. Because if you're not aware as the planner, you can't address some of the maybe possible shortcomings, or maybe there wasn't something that was disclosed at some point in time that is impacting their happiness that we're not aware of, so we're unable to address it.
We need to be brought into the loop a lot of times, and when we meet with new prospective clients along with reviews with current clients as well. And one of the, over half of our clients last year came from outside of the state of Texas because of the YouTube channel. And so there is definitely a trust factor that has to be built up from our clients that are not in the Houston area. And so one of the things we ask for in that first visit with our clients, it's a process. We have a process here to bring clients on board, is we're going to need to see your information. And a lot of times, like, well, I'd rather just see what you can do for me and so on. I use the example often. It is the equivalent of going to a doctor saying, I need a prescription.
Yeah.
Okay, tell me what's wrong with you.
You can't take my blood pressure.
Yeah.
I'm definitely not getting any blood. You're not poking me with anything.
You're not doing anything. Figure it out, doc. It's just go to your CPA.
Just show me what you can do.
Yeah, go to your CPA and tell him to do my taxes. Well, give me your information. None of your business. Okay, it's just not possible.
So, okay, Dustin.
Yeah.
What do you think about any? I have a couple questions I want to answer here. I'm going to give you guys the actual chance to answer them. But any thoughts about Ed's case study there?
Well, I think really what both of you are really touching on is there's so much about relationship building here. If the relationship isn't there, the trust isn't there, we're not able to really do our job. We can throw stuff at the wall, see if it sticks, but that's not helpful. We need to understand and know the situations that you're in to be able to help you and to provide that guidance for you. It's such a huge thing for every time I sit down with a client. I want to build that trust. I'm wanting to get to know their family. I want to get to know really what makes them tick and how they feel about these different things so that we can make proper decisions moving forward.
It's not always about the allocation or the investment returns because I'm going to share. First, I want to answer a couple of questions that you guys have typed in, and then I'm going to come back to just a quick story that kind of ties into what you've said there.
Yeah.
And my first probably 7, 8, 9, 10 years of working with families, building retirement plans, I didn't get this one thing. And once I really understood it, I was able to build much deeper relationships with the people that I work with. But not only that, put together plans that were more likely that they could stay committed to because I understood the things that kind of made them tick. So we're going to come back to that in just a second. First, Mike STGL. I love this question because we kind of address it, or we see it a lot, Mike, and definitely more than we like. And the truth is, it really is detrimental to you, the consumer, but we understand why you do it. So Ed, I'm gonna throw this to you, and then Dustin, you can chime in if you have some additional feedback. Mike STGL says, what are the drawbacks to using two different financial planners? Sometimes, he says, a lot of money with one group. So basically splitting your money across two groups, and what are some of the drawbacks to using two different financial planners?
Oh gosh, the list goes on and on. No, I hear that. We hear that very often. I'm going to let you manage a portion of my money, let you manage another portion. I'll go back to a real life, if you will, scenario that I've run into, and that is going through the analysis with my client, looking at retirement, looking at taxes again. And we were looking in this particular case at Roth conversions. We had a goal of what we were going to shoot for as far as a particular tax bracket we wanted to stay in. We look at tax returns here. He was very comfortable with what the tax bill was going to be come the very next year. We met again the next year to go through the same process because this was something that was going to be ongoing for the next 3, 4, 5 years. And lo and behold, the numbers came back much, much different than what we thought. Well, the firm that was managing his other assets, which we did not see, didn't do anything wrong, but they took a lot of profits. Well, that affected the tax plan. And so everything kind of pushed him into a much higher tax bracket than we thought. And so to answer your question, it goes back to visibility, not just for the client, but for us as well. Mm-hmm. We need to be able to see everything. And so the other reason I hear it is, well, I want to diversify. Depending upon what tools they're utilizing with Chris and Charles, we're generally using individual stocks and so on. You are already diversified. You may be using different investment philosophies, but the diversification is already there. I can attest to that, I sit close to them as well.
Yeah, I would say it goes back to goals as well. We may receive more information about your goals, about what you're wanting to do in our sessions that we talk about, but that investment planner or financial planner isn't receiving those. So therefore, we're planning one way, they may be planning a completely different way on the subset of questions that you've answered for them. So it's hard to quarterback that situation when there's two different quarterbacks playing.
And ultimately, we can't do our best job, and the other advisor can't do their best job. And a lot of times what we find is the client is taking more risk than they need to. Let's say you have an investment advisor that maybe has 7% of your money in Apple. Okay, you feel good about Apple. But let's say it's also a 4 or 5% position in our portfolio. Okay, now when you look at everything combined, you're at an overly aggressive allocation to one particular stock. And yes, you feel good about Apple, but things could go south. Apple could lose 20, 30, 40, 50% in any given year. So you have possibly an overconcentration because of the overlap of those two investment portfolios. So a lot of times it can be more detrimental. The planning is the big one, especially when you have no control over what the other planner is doing from an income distribution standpoint. It just completely, sometimes we won't even take a client in that particular situation because we can't do our job. Now, exceptions can be made, of course, and there are different circumstances where it's less likely to be very detrimental, but we've seen it before. I had one client several years ago. She had a commodities trading account with several $1 million in it. And I would get the tax return at the end of the year and ask her, where'd this $400,000 income come from? Oh, that's just my other planner over here. Or where's this $600,000 loss coming from? We could have been helpful to have that information, so we could have sold a lot of positions that we had at gains earlier in the year. So there's just this lack of communication, and we cannot watch every single client's outside investments. It's just not practical. So hopefully that helps answer your questions, Mike.
Troy, I want to elaborate on one other thing,
please,
and that is we never ever promote our services based on how low or inexpensive we are as far as our fee. I like to say that we're definitely not the most expensive, and you definitely, as something as important as retirement planning and tax planning, want to go necessarily with the least expensive. But if you are dividing your funds across multiple money managers, you may actually be paying a higher fee overall, because generally
you don't
with
get
us,
the economies of scale.
you don't get the economies of scales, which is also, if you will, detrimental.
Okay, a couple quick questions here. Tam says, when is a good age to start planning for asset protection? Let's say you're 24 years old with an $800,000 duplex and you own 3 acres. Well, Tam, as far as I'm aware, there is no law that says at 24 years old you cannot be sued and lose everything. So if you own assets, you should have some type of asset protection discussion with a qualified investment advisor, financial planner, or attorney. And the wise thing to do is to have the qualified advisor and the attorney in the same meeting, so the attorney understands the financial planning and the financial planning is aware of the legal planning, and all of those things can work together as one. So if you have assets, you should have an understanding of asset protection. At what net worth level, Lusky 68, at what net worth level does estate planning become a very high priority? This is a big misconception. A lot of people put off net worth or estate planning because they don't feel like they have, $8 million or $22 million. I'll say, $100,000, $200,000. If you plan on leaving money behind, let me give you just a couple quick examples. You give it to your child. There's a 50% divorce rate in this country. Are you actually giving money to your child, or are you giving money to your child's future ex-spouse? Okay, that is estate planning. The distribution of your assets, the retitling of accounts, the beneficiary designations. It's not just having a will and a medical directive and some of the other basic documents, but it's far more financial planning related. Step up in basis. Let's say you have a non-qualified account, a non-retirement account, and you live in a non-community property state. We've seen this all the time where you have joint ownership of that account within a marriage, and that joint ownership in a non-community property state is going to cause, when one spouse passes away, only half of that account value to step up in basis. Okay? If you have one spouse that's expected to pass away first, it would probably make more sense to consider titling that as a single account as opposed to a joint in a non-community property state. So 100% of that account gets a full step up in basis. That means you're paying a lot less tax upon the transfer of that asset to the surviving spouse. Those are just 2 examples. I could go down a lot more, and as a matter of fact, I will. We have an upcoming lunch and learn. So right here in Houston, we do lunch and learns right across the parking lot every single single month where we invite people to come, but we have started to record these. And my marketing director, Megan, has encouraged me to share these with you all. So we've started to do that. I believe, Charles, your last one was recorded. Ed, you did a Social Security one recently that was recorded. We're turning them into webinars. So I don't know the date offhand. Heather, do you know? October 11th. Are they live? Are we also going to send? Okay, so they're not live. We're going to record them, though, and put them out as a webinar. And the very next one that we're doing October 11th is estate planning. So make sure to tune into that one. Okay, guys, as usual, so much good information here. I'm going a bit long. Dustin, I want to talk about your case study. Before I do that, let's go ahead and do the raffle, because I know many of you have been waiting, and I told you we were going to do this around 7 o'clock. So we're going to do the second raffle right now. We are going to go through Dustin's case study, and then we're going to wrap this whole thing up in about, let's call it 10 to 15 minutes. And I'm going to answer a few more questions if we have time.
Perfect.
I'm kind of relieved we don't have the loud poppers in the background tonight.
Oh, so I'm not missing that one bit.
I can go get one.
No, it's okay.
Okay.
Robert, and the last name is R-A-U-S-C-H.
Oh, Roush. Okay, Robert. Congratulations, Robert. You are the winner of tonight's second raffle. So the marketing team will be in contact with you to coordinate the gift certificate or delivery of the gift certificate to your favorite restaurant. So, Robert, we appreciate you, and we look forward to getting that gift certificate. Okay, Dustin. Tell me what you have here as a case study. Tell us what you have as a case study.
Yeah, definitely. Well, these are clients that when I first joined, just like Ed's story, first came on, they were really paralyzed. They did not know if they could retire, if they couldn't retire. Had a whole lot of fear around losing that paycheck. That was the main driver there. And after a couple meetings with them, started to find out what really was the crux of this is the husband was worried about his wife, worried about when he passed away, who's taking care of her? Does she have enough money to continue to survive through retirement? He just was looking for every ounce to be able to take care of her. Now they've got about a 6-year age gap between them. They were very frugal throughout their lives, saved up. He managed all the money. So he was the one that was always buying and holding everything that he got. When they came to us, it was, I don't know what to do in retirement. I've accumulated all of this. What am I supposed to do?
It was the light bulb moment that we talk about.
Yep, exactly. So as we sat down, we started to put together that financial plan, uncovering more and more goals of what they were wanting to do in retirement. And that main big driver is, what happens to my wife? I want some guaranteed income for her. Through that whole process, we started to uncover that the best thing for them to do is to get some guaranteed so that he feels secured when he passes away, that she'll be okay.
So if we break that down, this is a great example of understanding that financial vehicles are really nothing more than tools.
Correct.
If you think of the tools that you use to put together something that maybe you buy from IKEA or you work around the house, if you have a nail, you use a hammer.
Right.
If you have a concern about running out of money, you use an annuity or you use a guaranteed lifetime income. If you need to screw something in, you use a drill. If you're like me and you can't find your drill, you use a screwdriver and it takes a little bit longer. Right. The point is you use the appropriate tool for the job. Right. And there are so many financial tools available to help craft unique solutions to actual fears and concerns that people have that a lot of times preclude them from living the type of life or enjoying the type of retirement that they otherwise could enjoy.
Yeah. Well, and I also want to make it a point that wasn't the first avenue that we took, right? We had multiple meetings before we actually arrived to that, because we had to uncover, just as Ed was talking about, we have to build that trust. We have to uncover that goal of what they're wanting to do. And once that trust was built and he was able to express that to me, then that light bulb goes off of, this can work.
Yeah.
This is a tool.
And so that's where What your job is as the investment advisor, as a retirement planner, is to understand what his need is, how much income we're talking about, do we want it inflation protected, how much, what is the asset base that we're working with, and then to simply research the marketplace and find the appropriate tool that solves that need. And then it's like you know what's satisfying when you're putting a puzzle together and you start to get kind of down to the end, and then you can't find that piece that fits, and you're trying all these different pieces, and they almost fit, but they don't quite fit. And then you finally find that last piece that goes right in, and everything matches up. You know, I get that feeling a lot whenever I'm working with a client and we find that tool, we find that solution that's almost like that puzzle piece. It's just that last little thing that you put it in place, and man, you know, they're happy. Everything that they were concerned about previously, those concerns aren't there anymore. Those fears have been alleviated, and you see them a year later, 2 years later, 3 years later. You know, we spend half the time on reviews a lot of time just talking about the grandkids and what they've been doing, because the money isn't a concern anymore. That's no longer, oh, Troy, the market was down 20% this year. What are we going to do? Yeah. You know, it's the plan is in place, and that is a cool thing. And that's why one of the reasons why I love what we do. I'm
right there with you. I mean, that's one of the most rewarding experiences for a financial planner, is when we can sit across from the table from a client and you can see the excitement that they have of, this is going to work. This is going to plan out the way that I want it to. So I think that is exactly why I'm in the industry. That's why I'm here, is to be able to help and have those relationships. Okay, so I told you I was going to come back to one story, and I told you I was also going to keep it short, so I'm going to keep my word. So back in 2008, clients that eventually came aboard, but not until almost 12, 13 years later, they lost a lot of money managing it on their own while they were still working inside their 401k. They went to cash, and they went to cash right before the market rebounded in, I believe it was March of 2009. But they were a few years away from retirement, and fear kicked in. So they felt the best thing to do was to preserve what they had left. They were in the heat of the uncertainty of the market crashing, and they made the mistake of going to cash. And I know maybe possibly some of you watching have made that same action at some point in your lives. This couple ended up staying in cash for over 10 years. So that's when they finally came to see us. And the market had returned about 15% a year on average from that March of 2009 rebound point. And at that point, after missing out on all those gains, they wanted to get very aggressive and go into the market. So they reached out. I do a radio show here in Houston, and they had listened to the radio show for some time. And they finally reached out. And they said, Troy, the way you talked about having a plan and the way you talked about retirement encouraged us to reach out and get to know you guys. Here's my point. They did not have visibility into how much they needed to actually save to support the lifestyle they wanted to live in retirement. They allowed fear and emotion to dictate their decisions, and it cost them over 5 years of their possible retirement they could have been enjoying. We went through the analysis, and if they would have been working with someone to help provide visibility into the future of what their asset base needed to be to generate the income they wanted for the lifestyle they desired, they could have had a low-risk portfolio that generated modest returns, and it would have got them to where they were going. But instead, they went it alone. Part of the reason was, too, they didn't want to pay fees because they had lost so much money. They didn't want to incur any excess possible loss of principal. So they stuck around in cash, kind of went on their own. And by the time they gathered enough courage and desire to sit down and actually get some help, it wasn't that it was necessarily too late, but they had missed so much of a run-up in the stock market. They started to have the opposite end of the spectrum when it comes to emotions. They were in fear for forever. Then they went into greed. Fear of missing out. We've been watching the market consistently do well over time. I now feel like I am missing out and I need to get in. Well, I can tell you any financial advisor who's been doing this for any amount of time will tell you they have a certain number of clients that whenever the clients call them and tell them they want to get out of the market,
that's when it's actually time to invest. And then whenever a certain segment of clients calls and says, Troy, I want to get in the market, that's when you should actually consider about reducing risk. So this was one of those situations, and we almost didn't take them on as clients because they were insistent on wanting to invest very aggressively to make up for the time that they had lost. The truth of the matter is, because we put the plan together, gave them visibility into how much income their portfolio could generate along with the tax plan, I let them know that this was the allocation that we recommended. If you're going to go 100% stock or 90% stock, I'm not going to be your advisor because I don't think you can commit to that plan if I put it together, and you're going to be mad at me when things go wrong. So having a plan allowed the visibility for them to make a better decision about how to appropriately invest their money. And guess what happened in 2020? COVID hit, and the market went down 40% in a couple of months. Do you think that family would have stayed invested through COVID if they had taken the allocation that they wanted to invest when we first had these discussions? I don't think so. So we talk about planning. And really what we do as investment advisors is create visibility for people to see how they need to invest, how much income they can pull out, different cycles of income. We may have much higher income in the first 3, 4, 5, 6 years of income. From which accounts do we withdraw that income? How do we pay less tax? And if something happens to me, will my family, the people that I love, be okay? That's what the Retirement Success Plan is designed to do here. That's what we've dedicated our careers to, and that's what we feel is the most important thing when it comes to retirement planning. Yep. Guys, any thoughts about either your case studies, each other's case studies, or just retirement planning, the Retirement Success Plan, before we wrap it up tonight?
I'll elaborate on what Dustin said about the annuity, and that was very, very, I think that's very important. We did not lead with that. A lot of times you hear the word annuity and everything, negative connotations. We're real big on education here. But first and foremost, it's just another tool, just like stocks, bonds, real estate. Everything that we or the investment team invests in for our clients are tools. By themselves, they have their pros, they have their considerations, but we would never tell anyone to put 100% of any of their assets into any of these one tools. By spreading it out, as you use a lot, it makes a pretty tasty little cake. By itself, not too salty, not too sweet.
Yeah. The only other piece that I would use in this scenario, it kind of goes back to when we were talking about having the investment team up here about the dividends. There's also a piece of those annuities that we can utilize in down markets, right? We've got free withdrawals that we can utilize to be able to mitigate a little bit of that sequence of returns risk. I think that's a powerful tool that is underutilized. And think that that's something that needs to be thought about.
Yeah, especially when you have a lot of the fixed indexed annuities out there with 100% principal protection, the ability to lock in gains every single year, potentially double digits when you have 13, 14, 15% annual upside with no downside risk and no annual fees. Right. A lot of people think annuities have big fees. Fixed indexed annuities typically have no annual fees. Now, the downside, of course, is you have limited liquidity. You have surrender charges. So we didn't talk about it, but you didn't put 60% or 80% of that family's money into that fixed indexed annuity. It's a smaller percentage. That's a tool. And when you reverse engineer the amount of income that they need compared to what are some of the most competitive rates in the marketplace, and if that equates to 10, 15, 20, 25, maybe 30% of that retirement account, and the client says, yes, I'm going to be able to sleep at night if we do this. That's where the tool makes sense. So, guys, this has been amazing. Thank you very, very much for coming up.
Thanks for having us.
We had a great conversation, so I did not get to all of your questions, but join us again for next month's live stream. And we mentioned the webinars, the estate planning we have coming up October 11th. It will be on the website and YouTube a few days later, typically. So make sure to check that out. And again, thank you all very, very much. Those of you that are clients, we really appreciate your trust that you give us. And those of you that are not, we really hope that you find value in these conversations. Have a good night. Go Lions.